An awful lot to sift through there. For more on the broader markets, we're joined by Mona Mahajan, Edward Jones, Senior Investment Strategist. Nice to see you. So let's put that all together. Anything you're seeing in the markets, or of course that JOLTS number that might change the thinking of the Fed as we approach that pivotal meeting?
Yeah, you know what? I think tomorrow's meeting, we're probably going to see that 75 basis point rate hike that would bring the Fed funds rate close to 4%. Keep in mind, they've raised now 400 basis points, or they will have raised after tomorrow, nearly 400 basis points in a year, which is really unprecedented. And I do think it warrants perhaps a bit of a more gradual pace going forward, just to see what that lag impact to the real economy may be in the months ahead. Now, the good news or silver lining, of course, for the U.S. economy is thus far we're starting really from a position of relative strength. We saw that not only in the U.S. GDP report last week, the labor report continues to be strong. We may see another meaningful report this Friday, but the unemployment rate at 3.5%, still near record lows, very strong wage gains, very strong, increase in labor force participation is starting to creep up as well. And so broadly, what we'd say is we're starting from a position of strength, but the Fed has raised very quickly, and probably, there tends to be a 2 to 4 quarter lag impact to the real economy. We may start seeing that in the months ahead. But the good news is, again, if the Fed does indicate in any way that there is perhaps a more gradual pace for the December meeting, that could be a positive. But the last caveat to keep in mind, of course, is that we've gone into tomorrow's meeting already up nearly 14% on the Dow, 8% on the S&P. The risk reward may be skewed the other way after tomorrow, at least in the near term.
When you mentioned the fact that it could make sense in order for the Fed to slow down its pace of rate hikes, what about putting it on pause? Could that potentially make sense as we look out to 2023?
Yeah, for that to happen, I think we would need to see a couple of things fall into place. And first and foremost, of course, is the inflation story. The Fed and global central banks are raising rates to bring down demand, to bring down the consumer, the consumption, and ultimately to bring down inflation. So we would hope, some of the underlying fundamentals we're seeing in terms of, leading indicators like ISM prices paid, break-even inflation rates, even supply chain indices are starting to show signs of easing. And we would hope over time that shows up in things like CPI inflation prints as well. So number one, we would need to see inflation cooling in a more meaningful way. And keep in mind, we're starting to also see that a bit in the housing market, where we're getting a little bit of, some signs of cracking there as mortgage rates have doubled over nearly 7% now in the U.S. economy. The second thing we'd probably, like to see in terms of a slower pace of Fed rate hikes, of course, is perhaps some cracks in the labor economy, or some signs that consumption has really started to slow. The Fed is trying to raise rates in order to cool that. I think any sign that either wage gains can moderate, or perhaps consumer demand is rolling over, whether we see that through earnings or economic growth, that will give the Fed a little bit of comfort that perhaps what they've done already may be enough. We don't think the Fed necessarily wants to push the economy into an unnecessarily deep or prolonged recession or downturn. And so we do think they're mindful of that, although we do think their rhetoric tomorrow will likely still be vigilant, a little hawkish.
And Mona, you mentioned the consumer, and for some people, it really has been a tale of two sets of consumers, depending on your income bracket. What are we seeing in terms of the resilience of the consumer right now? Yeah, absolutely.
Look, inflation has hit almost all consumers in the U.S., whether it's at the gas pumps, whether it's at the grocery stores, and really in all walks of life. Housing prices prior to more recently had been elevated as well. But generally, when we think about consumption, you look at personal consumption growth and in the GDP report, for example, as really a gauge of consumer strength, that has shown some resilience. It was 2% last quarter. It fell to 1.4% this past quarter ending September 30th. Still, moderating trends, but still, relatively resilient. But interestingly, when you look under the surface there, what's driving that growth is a demand for services. So all the leisure, hospitality, traveling we've been doing over the summer months has shown up as services demand. When you look at goods demand, that's where we're really seeing negative growth actually over the last quarter. So there's really been this shift in consumption and consumer behavior away from goods, all the Amazon packages we were buying, towards services. So it'll be interesting to see in the months ahead, especially if that trend continues to hold, or we do get a softening in the services and ultimately a softening in the consumer.
Mona, I wish those Amazon boxes would stop showing up at my house. It's still every day.
We get them too.
I know you're watching the yields, in particular the spread between the 10-year and the 3-month, which are telling you and ought to be telling the Fed what?
Yeah, it's interesting. The 10-year, 2-year curve had inverted months ago, and actually since mid-July it's been negative, and that was our first kind of yellow to red flag that perhaps a slowdown is coming. And keep in mind, an inverted yield curve tends to mean that a recessionary period or downturn is forthcoming, but there's a lag again between 6 and 18 months. The one that we tend to pay more attention to, and I think the Fed does as well, is the 10-year 3-month curve. The 3-month yield tends to track more closely the Fed funds rate, and then the 10-year tends to tell you what the future of the economy and really inflationary pressures may be. And the 3-month has now exceeded the 10-year, and so we have an inverted curve there as well. And that's a signal as well that perhaps the Fed needs to go at a slower pace because what credit markets or parts of credit markets are telling them is that a slowdown is forthcoming. And so something to keep in mind, it's another one of those yellow flags that we've added to our list, including leading indicators, including a little bit of pressure on ISMs, including the housing market cooling, that tell us that the economy is on track to slow below trend growth at least. And so the Fed is watching all these metrics closely as well. And whether or not they hint it or not tomorrow will be interesting. But certainly having a 50 basis point rate hike in December, still an outsized rate hike, is likely on the table for them at this point.